Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, we are thrilled to be joined by investment strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well. How are you?
I'm doing really well. Thanks for asking. So we're coming up on the holidays, the end of the year, and you all released a great new piece, the new market gauge for December 2021, to kind of summarize where you all see the market as it stands. The gauge is neutral currently, so of the 16 categories, 8 on one side, 8 on the other. And just high level, I'd love to get your thoughts on what you're thinking about and what you're watching closely heading into 2022.
Yeah, so in the latest iteration of the market gauge, we left it unchanged, but as valuations is really what we're watching here right now. One of the things we take a look at is the rule of 20, and we view it as a good barometer of relative valuations. Now, to give you an idea of what the rule of 20 is, it's basically the sum of the inflation rate and the PE on the S&P 500, and over time it has averaged about 20. Therefore, the rule of 20. Today, that figure actually stands closer to 27, with the market trading at about 21 times earnings and inflation just above 6%. So, over time, we would expect this to mean revert back to that 20, which ultimately means that valuations and multiples are going to be a headwind for the market potentially going forward. The other concern that we have, which is less reflected in the market gauge at this point, but is something we like to bring up, is the potential for any new lockdowns. Ultimately, we believe this would be a policy mistake for the markets.
Yeah, that'll definitely be something to keep an eye on. And speaking of policy, let's flip to monetary policy. You all still have this labeled as favorable in the market gauge, but we know that the Fed wants to get more aggressive and they want to tighten quicker than expected heading into 2022. How are you all thinking through monetary policy at this point in time? What are you watching on that front?
Sure. Obviously, the Fed has turned more hawkish as of late, and the yield curve's been flattening. But it's important to remember that it's not necessarily the first rate hike that kind of slows things down. It's really the last one. On average, after the first rate hike, the S&P 500 is up about 6.5% in the 6 months following that hike. And we've based that data on the 8 prior rate hiking cycles. Typically, even leading up to that hike, the S&P 500 is up. And in the 3 months prior to that first rate hike, it's usually up about 5%.
Great. So something to keep an eye on, but maybe not something to necessarily get too worried about yet. All right, let's wrap up with a bit of a forecast for 2022. The gauge is really meant to be a snapshot at a moment in time. It's late 2021, but I'd love to hear your thoughts on what your outlook for equity returns is in 2022 as we face a bit of an uncertain road going forward.
Sure. So 2022, I believe there needs to be a level setting of market return expectations. Obviously, we've had several strong years, but 20% returns are not the normal. Earnings growth is already for 2022 is expected to be around 8%. It's obviously come down pretty significantly where the estimates were at the beginning of the year, and that's really a function of 2021 coming in stronger than expected. It may be ultimately we're looking at it as if some of those earnings growth were actually pulled forward. As I mentioned, we're watching valuations. That is a headwind, and on top of that, margins are certainly something to be focused on. Costs for the S&P 500 companies are increasing pretty significantly, and after this significant multiple expansion that we saw during 2021, it's actually started to slow some. The next 12-month estimated operating margin peaked at about 17%, and now it's settling around 17%. This is all very typical for the part of the cycle that we're entering, but as I mentioned, you have to remember that these 20% return years are not, are not the normal, and maybe a little bit of, call it 8 to 10% is probably where we should be looking for next year.
Yeah, definitely not normal, but certainly appreciated. And truth be told, 8 to 10% is still a really nice year for the S&P, especially after such a great run, especially when it's being driven by earnings growth, as you note. So, Ryan, I want to thank you so much for your time today. It's been really instructive for us and for our clients. So, if I don't speak to you again, have a great holidays, and we'll talk to you soon.
Thanks, Ross. You as well.